Today we're looking at a very high-stakes analysis of Nebius Group, or NBIS. It lays out an aggressive bull case, arguing its 328% rally is just the start, all driven by these huge hyperscaler contracts and a projected $7 to $9 billion revenue target for 2026.
Yeah, it definitely captures that energy, the supply-constrained utility narrative perfectly.
It does.
It gives you a really compelling vision of what Nebius could be. But, and this is the big but, moving from a vision to an ironclad thesis, that's where you hit the main challenge.
The inherent contradiction of hyperscale growth.
Exactly.
And that's precisely where we have to start. While the report does a good job isolating the key risks, execution risk and margin compression, integrating them earlier, more directly into the main discussion would, I think, significantly strengthen the overall conviction.
Right, I get the impulse, You want to present the bull case cleanly, let it shine, and then you just tack on the risk section at the end.
The disclaimer.
The requisite disclaimer. Section 5, right, where it mentions the $120 million net loss?
Yeah.
But for a really sophisticated audience, that structure, it actually does the opposite. It reduces conviction. It sort of implies the analyst sees the risks as secondary.
It's the difference between saying, here's the bull case, and oh, by the way, here are some risks, versus saying, despite these massive, immediate risks, here's exactly how the company overcomes them.
Yes. The second one shows you've actually wrestled with the problem. The analysis has to show how that projected scale will definitively, overcome these specific headwinds.
That's the whole game. The high-growth utility model, especially in AI infrastructure, is all about how much capital and energy it eats.
And the weakness right now is that the report is so overwhelmingly bullish that pushing those immense costs into a tiny section at the end it weakens the whole thing.
But is there a risk, though, that if you get into detailed margin modeling too early, you kind of dilute the main message, that big $7 billion ARR target?
That's a fair point, but you don't need to add pages of spreadsheets. You just reframe the catalyst.
Okay.
My suggestion is really structural. Instead of isolating the risks, wrestle with the central contradiction right there in the main discussion. How can that $5 billion in CapEx for 2025 drive revenue while also guaranteeing that operating costs are going to just soar?
So you reposition the flip to profitability. It's not just a financial goal. It becomes the primary execution goal.
Precisely. You show you understand the trade-off. So when you talk about the hypergrowth and that Q3 revenue exploding 355% is a stunning number.
It is.
You have to immediately frame the cost of that growth. Don't just celebrate it. Ask the next question. At what rate are operating costs rising to fuel that 2.5 gigawatt capacity target?
Okay, so a concrete example. Instead of just stating the $120 million net loss, the analysis could model the margin compression, maybe with some stress tests.
Yes, exactly. Illustrated. Show what happens with, say, a modest 10% rise in energy costs combined with the pressure of hiring talent to manage all that new capacity. Show how that could push the break-even point further out.
It grounds the projection in reality.
It shows you've stress-tested the downside and you still believe the thesis holds. That's how you build real conviction.
Okay, moving on from risk integration. Let's pivot to the mechanics of actually hitting those revenue targets. This is where the execution risk really becomes, palpable.
I mean, this is the heart of the bull case, isn't it? Going from a $1 billion run rate up to maybe $9 billion by 2026.
The ambition is just enormous.
And the market is absolutely right to be skeptical about the speed required to do that.
So the massive projected leap in annual recurring revenue is the single most critical driver here. And the report could really benefit from a more rigorous, a more mapped out connection between that $5 billion CapEx and the tangible deployment milestones.
The analysis report itself notes the market is pricing in execution risk. And that's totally true.
Of course.
But the risk stays high because the analysis gives you the total capital, that huge $5 billion, but it doesn't map that investment to the specific capacity, the gigawatts coming online.
And it doesn't explicitly connect that new capacity to fulfilling the $20.4 billion backlog from Microsoft and Meta.
No.
The link between the capital, the capacity, and the revenue, it's sort of an implicit assumption the reader has to make.
It feels aspirational.
Not engineered.
Exactly.
And when you're building a bull case on a stock that's already up over 300%, aspirational just isn't going to cut it.
So the suggestion here is to shift that perception entirely.
I think so. You need to create a clear, future-facing roadmap, maybe in that revenue air pocket section, a timetable that directly links the capital deployment to activating capacity.
So it shifts the whole thing from aspirational guidance to something that feels more like mechanically guaranteed revenue.
Yes, you're showing the mechanics. You're forcing the reader to see NBIS as an operational entity, not just a stock ticker.
So how do you map it? Instead of just a lump sum, you break it into phases. Yeah, connect the dollars directly to the outcome.
So, for instance, the report could say something like, Phase 1, first half 2026. The initial $1.5 billion deployed results in 500 megawatts of new capacity. That's dedicated to the Microsoft contract, and it immediately unlocks the first $1.2 billion of that deal.
That level of detail is exactly what's needed. You're mitigating the execution risk narrative right there. And then you can use the established deal flow, that $17 billion from Microsoft, the $3 billion from Meta, to anchor the 2026 targets with precision.
You could show exactly what percentage of the total backlog has to be delivered in 2026 to hit the $8 billion midpoint.
Your work. If $8 billion is the target, you can illustrate that this means they have to commission, Y gigawatts of capacity per quarter. It removes all the ambiguity.
And it proves that the analyst has gone beyond just taking management's guidance at face value.
It shows they've reverse engineered the operational tempo. That is the hallmark of really robust analysis.
Okay, for our last point, let's turn to the source of the competitive advantage itself, the moat.
Right. Because if Nebius is going to pull off this unprecedented build, they have to have a proprietary edge that their clients, Microsoft and Meta, of all companies, can't just replicate themselves.
We need to deepen the quantitative differentiation of this infrastructure supremacy moat.
Couldn't agree more. The material correctly identifies the core advantages: the AI-native cloud, the bare metal performance, proprietary tech.
But they're buzzwords.
They are. And for an audience that lives and breathes data center metrics, descriptive language just isn't proof.
Terms like no virtualization overhead or proprietary orchestration software are mentioned, but where are the metrics? For this kind of audience, relying on description leaves the door wide open for skepticism.
The question they're asking is this genuinely superior or just a marginal improvement over what AWS offers or, frankly, what Meta can build in-house?
That's the critical point. If NBIS is truly indispensable, it has to be because they offer a measurable, massive efficiency gain.
Especially for LLM training. That's the specific workload driving this entire thesis.
So the suggestion is to provide some, maybe hypothetical or estimated performance metrics that explain why. Why did Meta and Microsoft choose Nebius over just scaling their own infrastructure?
Let's start with bare metal. Instead of just saying no virtualization overhead, you have to quantify the impact of that. The efficiency of the H100s, the GPUs, that is the real commodity here.
That's the most actionable place to start. For example, the analysis could propose a metric, something like, the bare metal performance yields a measured Y% increase in effective H100 utilization, which translates directly into X months faster time to market for a new LLM.
Now you're talking. That immediately gives the audience a clear ROI metric. You are quantifying the value prop in the currency the hyperscalers actually care about: speed and utilization.
And we can apply that same principle to the other proprietary tech, the custom server racks, the orchestration software, the operational side of the moat.
Yes. If the execution risk is high, the tech has to be what mitigates it. So, give us a metric. Proprietary orchestration software allows Nebius to achieve X% faster deployment time for new clusters than the industry standard,
which directly addresses the aggressive schedule that the financial projections demand.
It proves they can hit it. You're moving the infrastructure supremacy from just a claim to a validated, measurable advantage.
Look, this whole analysis is a very strong foundation for a high-conviction bull case. It makes a great argument that the 300% gain was just the beginning.
I agree, but for any report relying on such aggressive targets, you have to maximize its impact, and you do that by subjecting it to the highest level of skeptical scrutiny yourself.
So, to quickly recap the actionable suggestions to get there.
First, integrate and model those margin compression and execution risks directly into the catalyst discussion. Don't hide them. Show that you've wrestled with the complexity of scaling.
Second, create that explicit execution map. Link the $5 million CapEx directly to capacity and then to monetizing that $20 billion backlog. Show how the ARR target is mechanically guaranteed.
And finally, quantify the proprietary moat. Move beyond the descriptive language. Give us clear, measurable advantages like increased H100 utilization or faster deployment times that prove Nebius offers something truly superior.
If these